Alright, so here's a dilemma that a lot of first-time investors run into. Should you buy one expensive investment property in a premium suburb or two or three cheaper ones spread across different areas? Some people swear by the blue chip capital growth approach. Others say buying cheaper properties with higher rental yields is the only way to win. And the truth is, both camps have some really strong arguments. There's no single correct answer because it depends on your strategy and your current situation, as well as your risk appetite. That's what we're going to unpack today. We'll walk through the pros and the cons of buying one more expensive blue chip style property versus spreading your money across multiple cheaper properties. We'll look at how the numbers and the risks stack up, and then talk about some hybrid options so you're not forced into an all or nothing choice. By the way, I'm Nick. I'm a mortgage broker with Kingfisher Finance Group, and I specialize in helping first-time buyers and investors get into the property market and structure their loans in a way that actually supports their long-term goals. Before we dive into the two strategies, let's talk about why this decision matters so much right now. The property market isn't what it used to be. 10 or 15 years ago, borrowing was easier, prices were lower, and you could buy a lot more for your money and let the time do the heavy lifting. Fast forward to today, it's a completely different game. In many parts of Australia, median house prices are brushing up against or well past the $1 million mark. At the same time, interest rates have climbed over the last few years, which means your borrowing capacity has actually dropped to when the rates were at rock bottom. Most investors don't have the luxury of buying multiple properties straight away. For a lot of people, the bank will basically give you one good shot, and you might be able to buy one high-ticket investment property, or you might be able to stretch that same borrowing capacity across two cheaper ones. But either way, the first move matters. That's why this decision is so important. Do you go all in on a single, more expensive blue chip property and hope for strong capital growth? Or do you break that budget up across maybe a couple properties that are more affordable, boost your rental income and spread your risk? Now, it's not just about numbers on a spreadsheet. This choice can shape the next 5 to 10 years of your investing journey. If you buy one expensive property, you might tie up your borrowing capacity and not be able to do anything else for a while. If you buy multiple cheaper ones, you get diversification and better cash flow, but you also get more moving parts to manage. So let's start by looking at the first approach, putting your money into one more expensive investment property. Think of this as the blue chip strategy. We're talking about properties in a premium, in-demand locations, inner city suburbs, lifestyle areas, or other well-established pockets where people really want to live. Often, these are around the $1 million mark or even higher. The first big benefit is the capital you've got invested in the market. If you buy a $1 or a $1.5 million property, you've got a large asset base working for you straight away in a single transaction. It's simpler with just one purchase, one set of fees, and one loan, as well as just one property to manage. That just means fewer headaches compared to juggling 2, 3, or 4 smaller deals spread across different locations. The second benefit is potential capital growth. Blue chip suburbs tend to have higher income residents and more consistent demand. Over time, as incomes grow, people can afford to pay more to live in these areas, which can push prices up faster than in lower demand locations. That's where you might see a $1 million property doubling to around $2 million over 7 to 10 years, depending on the market cycle. That growth is happening off a bigger base as well, so each percentage point of growth adds more dollars to your net worth. You also typically get better tenant quality. Higher value areas tend to attract tenants with stronger incomes and more stable employment. They're often more reliable with rent and more likely to look after the property as if it's their own. On top of that, banks generally like these areas because they see them as lower risk with strong demand, tight rental markets, and solid resale potential. But now let's flip the coin, because the downsides are just as important. The first challenge is the deposit cost. A 20% deposit on a $1 million property is $200,000. And once you add stamp duty, legal fees and other costs, you could be looking at needing $250,000 or more just to get in. That's a huge hurdle for most people. And while there are other options, such as using a smaller deposit and paying LMI, using an LMI waiver, or even using a guarantor, these options aren't always possible. The second issue is the holding costs and cash flow. More expensive properties usually come with lower rental yields. For example, a $1.2 million house might bring in around $36,000 a year in rent, which is around a 3% rental yield. But with today's interest rates, the mortgage repayments on a loan that size might be $70,000 or more per year, without even factoring in management fees, maintenance, and other costs. That's a big cash flow gap you're covering out of your pocket. You're essentially banking on capital growth while sacrificing your cash flow. You might also hit land tax thresholds much faster in certain states, which adds to your ongoing holding costs. On top of that, you've got concentration risk. When you put all your money into one property in one suburb with one tenant, you're fully exposed to whatever happens there. If the local market stalls, you're stuck. If your tenant moves out, you've lost 100% of your rental income until you find a new one. If something expensive breaks, there's no other property in your portfolio to cushion that blow. Another hidden risk is borrowing capacity. One big mortgage can chew up a lot of your serviceability. From the bank's perspective, that's a lot of debt. So even if your property is growing nicely in the background, you might not be able to access equity or borrow more to buy your next investment property for quite a while. So that's the picture with one expensive property. Strong potential growth, high quality area, simple management, but big upfront and ongoing costs, lower yields, and less diversification. Now let's flip to the other strategy, buying multiple cheaper properties instead of one big one. This is a really popular approach for first-time investors. Instead of putting all your money into one blue chip location, you might be able to buy 2 or 3 properties in more affordable suburbs or regional centers. Think price points in the $500,000 to $600,000 range rather than that single $1 million plus property. The first big advantage here is the lower entry costs. Instead of needing $250,000 to get into a $1 million property using a 20% deposit, you'll be able to buy a $500,000 or $600,000 property with about half of that cost. That's a lot more achievable for many people and could get you into the market a lot sooner. The second advantage is yield and cash flow. Cheaper properties often have a higher rental yields. For example, a $600,000 property might rent for $30,000 a year, which is a 5% rental yield. If you own 2 of those, you're looking at around $60,000 in rent each year, compared to the $36,000 on that single $1.2 million purchase. That extra income helps you cover your loans, reduces your personal cash contribution, and gives you a bit more breathing room. The third big benefit is diversification. If you split your investment across a few different properties, you can spread them across different suburbs or even different states. Maybe one in outer Brisbane, another one in Melbourne, and maybe one in Perth. If one market slows down, the other 2 might still be ticking along. If one tenant moves out, you still have rent coming in from your other properties. You also have more flexibility. If you suddenly need to free up some cash, you can sell one of your cheaper properties and keep the others. With a single high value property, it's all or nothing. You either keep it or you sell it, the entire asset. But again, there are trade-offs. The first challenge is management complexity. Instead of one set of rates, one insurance policy, and one property manager, you've now got 2 or 3 of everything. The second challenge is tenant quality and maintenance. Not all cheaper properties are in rough areas, but some will be in lower socioeconomic locations. That can sometimes mean more wear and tear, more frequent vacancies, and more issues with rent payments. And remember, the cost to fix a hot water system or replace an air conditioner is roughly the same whether the property is worth $300,000 or worth $1 million. In a lower rent property, that maintenance bill is a much larger percentage of your income. The third drawback is capital growth. Generally, cheaper properties are not in the absolute best, most in-demand suburbs. They might be in outer ring areas or regional towns. Historically, these markets don't often grow the same as the premium inner city or lifestyle locations. So while you might enjoy better cash flow, if you buy in the wrong market, the total growth of your portfolio over 10 or 20 years might be lower than if you'd focused on one or two higher growth assets. And another thing is that the banks still look at your total debt. 3 loans of $400,000 each is still $1.2 million in lending. Yes, the stronger yields help your servicing, but if your income isn't growing quickly, you can still hit that borrowing ceiling. So now that we've looked at both strategies separately, let's put them side by side. Imagine 2 investors. Investor A buys one $1.2 million blue chip property. Investor B spreads that same total spend across 2 $600,000 properties in different cities. On the capital growth side, looking at the last 25 years, blue chip suburbs have grown at around 10% per year, meaning the $1.2 million property could be worth over $3.1 million in 10 years. If both of the cheaper properties grow by around 5 to 6% per year, together they might reach around $2 million in that same time frame. So purely from a growth perspective, the single expensive property can come out ahead, assuming the suburb performs as expected. On the rental yield and cash flow side, Investors A property might bring in around $36,000 per year in rent at a 3% yield. Investor B's 2 properties, each at a 5% yield, might bring in around $60,000 per year combined. That's a big difference in income and can be the difference between constantly topping up your mortgage from your salary versus having the portfolio largely carry itself. In terms of risk and diversification, Investor A is fully exposed to one location and one tenant. Investor B is spread across multiple markets and multiple tenants. On borrowing power and future growth, both investors have roughly the same amount of debt, but the servicing position can look quite different. The stronger cash flow from the cheaper properties can sometimes make it easier to get the bank to say yes to future loans, but at the same time, the absolute level of debt is still a constraint. So it sounds like both strategies have some clear wins, right? One gives you stronger growth potential and simplicity, the other gives you better cash flow and diversification. Does that mean it's an easy choice? Not quite. Here's the reality check. Neither path is perfect. With the one expensive property strategy, the big challenge is servicing and cash flow strain. That single mortgage can put a lot of pressure on your budget, especially if interest rates rise or your circumstances change. You might also be stuck, unable to buy anything else for a long period of time. With the multiple cheaper property strategy, the challenge is management and growth. You've got more moving parts, more admin, and in some locations, potentially slower capital growth. On paper, it feels great to say, I own multiple properties, but if they're not growing much faster than inflation, you might not be building wealth as quick as you think you are. The key questions become, can you handle the cash flow risk of a big growth-focused property? And can you handle the management load of multiple smaller ones? And does this strategy actually align with your long-term goals? The good news is, this doesn't have to be an either-or decision. Smart investors often blend both approaches over time. For example, you may choose to buy one growth-focused asset and one higher-yielding asset. Maybe you buy an inner-ring townhouse in a capital city for growth and pair it with a more affordable house in a strong regional hub for yield. Together, your rent is higher than if you just owned one big blue-chip property by itself, but you still have good exposure to a quality location. Another option is sequencing based on your goals and constraints. If your number one aim is to build equity quickly, you might start with the high growth property first, then add in a second high yield property later to help your cash flow and improve your servicing. If your budget is tight and you're nervous about cash flow, you might do the opposite. You might start with a cheaper, high yield property to get into the market, then aim for a growth asset once your position improves. You can also look at manufacturing some of your own growth instead of just relying on the market. That might be through a cosmetic renovation, adding a granny flat where zoning allows, or buying a dual key or duplex style property that gives you 2 rents from 1 purchase. These kinds of moves can increase both your equity and your income if they're done carefully and the numbers stack up. Another layer to think about is geographic diversification and tax. Spreading assets across different states can reduce your exposure to a single market cycle, and in some cases help manage land tax over the long term, because each state has its own thresholds and rules. And then there's how you structure the finance itself. The same property can feel very risky or quite manageable depending on how you set up the loans and your buffers. Keeping a cash buffer in an offset account, using interest-only loans, and making sure you've got access to liquidity all make a huge difference in how comfortably you can hold these properties through interest rate changes and vacancies. So here's the big takeaway. There is no single best strategy. There's only the best strategy for you at this point of time. If your number one aim is long-term wealth creation, you've got a strong income, and you're comfortable riding out some cash flow pain, then leaning towards a more expensive, growth-heavy property might be the right move. Over time, the compounding growth on a premium asset can be a serious wealth builder. If you value stability and flexibility more, and you'd rather spread your risk and have stronger rental income coming in, then building a portfolio of cheaper properties can make a lot of sense. You might sacrifice some growth potential, but you're likely to sleep better at night knowing your cash flow is in better shape. And remember, your choice today isn't permanent. You can start with one style of property and balance it out later as your income, family situation, and risk tolerance changes. The real power is understanding the trade-offs and building a plan that lets you stay in the game long enough for compounding to do its thing. So instead of asking which strategy is better in general, start asking which strategy is better for me right now, given my goals, my income, and my risk comfort. If you're listening to all this and thinking, I like the idea, but I've got no idea what the bank will actually let me do, that's where getting some tailored advice helps. As a broker at Kingfisher Finance, I sit down with clients every day to help map out their borrowing capacity, run through scenarios like the ones we've talked about, and figure out what strategy actually fits their needs. If you want to explore what this could look like for you, you're always welcome to reach out and have a chat about your situation and your goals so you can make a more confident decision about that first or next investment move.